All right, for more on July's inflation print, we have José Torres, senior economist at Interactive Brokers, joining us now. Jose, good to see you here. I think throughout Yahoo Finance's programming, at least from 9 to 11 today, you'll hear a lot of economists say this is a Goldilocks economy. I'm not a fan of that term. Is it just an amazing economy because it's slowing but not too fast, and we're going to get more rate cuts and growth might pick up in the back half of the year?
Well, Brian, great to see you. I don't think it's an amazing economy, and the reason it's not phenomenal is because consumers and households alike are managing their budgets like light switches. Some months we're seeing significant consumer spending, while others, they're really hunkering down, looking to alleviate the budget from past spending and also looking to save a little bit and provide more space for further months. We saw that in June. June spending was weak, and July has been a huge expansion. As far as inflation, inflation has been a terrific story, Brian, and really has been all about goods and commodities cooling off. When you look at automobiles, they've declined in price every month this year. When you look at commodities, despite geopolitics geopolitical tensions beginning to mount, commodities prices are really well anchored. And those two dynamics have really brought price pressures lower. As far as services, it's been a little mixed, driven by the consumer spending ebbing and flowing sharply, but then also housing. Housing prices are at all-time highs, rents are still high, and those are still headwinds for inflation.
Jose, it's great to see you. As we were taking a look on the screen at the Fed's preferred inflation gauge, PCE, this morning, and really trying to get a sense of what this does, if anything, for what we've already heard from the Fed going into that September meeting that's going to take place in just about 3 weeks, the 17th and 18th here. We're watching the CME Fed Watch probability here, and it's just eased further towards this probability of a 25 basis point cut. So does this preferred inflation gauge do anything for September? For those who are looking for a 50 basis point cut and just kind of cooling those expectations? And then what is the signal for the rest of the year?
Well, I think as the Fed walks down the monetary policy stairs, it's going to be a slow walk, similar to what we're seeing in the ECB. They cut once, and now they don't know if they're going to reduce rates further. A serious consideration, alluding to what I spoke about earlier with the used cars, when rates start to come down, what's going to happen to pricing power at automobile dealerships? What's going to happen in the real estate sector? You have a lot of folks that want to get in, they want to buy homes. You have an underbuilt condition, substantial immigration flows. So as you begin to reduce rates, you have risks that the economy starts to overheat. Today's report also strongly supported 25 because look at the spending numbers, Brad. The spending numbers were terrific. Folks are out there, they're spending on services.
Jose, let me push back on that a little bit. I want you to take a listen to what Dollar General CEO Todd Vasos had to say about the consumer yesterday on his earnings call.
I found coming back is that our everyday low price was very competitive and continues to be even to today. So that gives us great confidence and a very good springboard to launch this promotional activity that we know exactly how to do and to be able to bridge the end of the month for our core customer because she's running out of money.
Jose, why are shoppers running out of money? With prices coming down, shouldn't shoppers have more money? And what's the risk to the economy when you have a low-income America running out of money the third week of every month?
No, there's significant risk. Overall, late cycle dynamics, particularly at the low end. Remember, Dollar General, Brian, tends to be a retailer for more lower and middle end households, and the consumer has been really bifurcated. You have those consumers that tend to be older, have more exposure to real estate, have more exposure to stocks. They're not doing particularly bad. The market has done terrific. But when you look at the consumer that's really focusing on labor income and is constrained by the pressures of higher prices, tall interest rates, reduced credit availability, and now job uncertainty, I think that's what explains the weakness there. Against the backdrop, Walmart has been gaining market share. That's something that we see also in late cycle dynamics. Back in 2008, we saw the same thing. Folks started to downgrade from spots like Nordstrom, Target, Best Buy, and go into Walmart instead.
Well, it's the trade-in to Walmart, as the CFO, John David Rainey, had told us here on Yahoo Finance, that they're seeing from the higher end of the income spectrum as well. So Is that alone enough to be a catalyst to propel Walmart to outperform against other retailers right now, especially if the high income cohort right now is the one that's being relied on to offset what we're seeing in low income cohorts?
Overall, I think that the shift towards Walmart just speaks to budget constraints being too heavy overall. Because remember, even higher income consumers, they're seeing some trouble too. They're nervous about stock market bumpiness. Folks are also worried about the election. We're going to get consumer sentiment in roughly an hour. Against that backdrop, there is general uncertainty as far as what's going to happen with rates. As rates slip, there's a chance that the job market does hang in there and that we don't see the unemployment rate start to accelerate. Because in the past, we've seen when joblessness starts to pick up, it really starts to ramp. And really the Econ 101 concept there, folks lose their jobs, they stop spending on other spots. Those spots now face revenue pressure. They have to release other folks. But since corporate balance sheets, Brad, are so strong this time around, we do have high odds of a soft landing. Maybe we don't fall into a slowdown and we can keep the expansion alive for a few more years.
Jose, what's your base case for GDP next year?
1.5%.
Is that why? To me, that's a slowdown from this year. But is that the definition of a soft landing?
I think so, right? I think, as long as we don't go zero or go negative and we don't have any major credit issues, we don't have sharp job losses, as long as we can stay above water, I would consider that a soft landing. Remember, we can go down to 1.5, 1%, and then we can rebound, right? We can start, if inflation comes in closer to that 2%, then maybe the Fed can start to reduce and get closer to that 3% Fed funds and provide some kind of stimulation, going further. But right now, the main focus is, can the Fed reduce rates without reigniting inflationary pressures? We're seeing those problems in Europe. They cut once, inflation comes back up. We've seen these problems here in prior cycles. Whenever the Fed wants to deliver a dovish message, they want to help out the market a little bit, and then inflationary pressures reignite. Let's remember, early this year, the market was expecting 7 rate reductions.
Yeah, we were all anticipating that based on what economists, some of your industry colleagues were really calling for and expecting us to look for.
I wasn't. I was looking for no cuts.
No
cuts. No, I was looking for 7. Nope.
Okay. One more thing, real quick,
yeah.
guys. The regional bank crisis in March 2023, remember, rates plunged. We thought we were getting cuts right around the corner, and they hiked after that, right? And then another important thing, gentlemen, is the Fed's balance sheet. They're going to keep reducing that even as they're bringing rates lower.
All right, we got to save that for our next conversation. Jose, great to see you. Thanks for joining us ahead of the opening bell this Friday. José Torres, who is the Interactive Brokers senior economist. Thanks so much, Jose.